Welcome to this webinar on the Saudi economy in partnership with the IMF and the release of its Article IV Consultation report presented by Tim Callan, who's Assistant Director of the Middle East and Central Asia Department at the Fund. My name is Karen Young, and I'm a Senior Fellow and Director of the Program on Economics and Energy at the Middle East Institute. This is our first event as a soft launch of our new program. You'll find more information about the program, our roster of sharp non-resident scholars, and some members of our advisory council, along with some video interviews on our webpage, and we're going to link that now in the chat. We're going to continue to grow, so please stay engaged with our program and get in touch. It's my pleasure to welcome Tim Callan and also our discussant for the webinar today, Faris Al-Sulaiman, who will be joining as a non-resident fellow with the Economics and Energy program. Faris is also a doctoral candidate at the London School of Economics and Political Science and a research fellow at the King Faisal Center in Riyadh. So Tim will present the IMF report findings, about 20-25 minutes, followed by comments by Faris, and then we'll have a Q&A session. I look forward to a productive conversation over the next hour. I'll be taking audience questions through Zoom's Q&A feature, so you can find on all of your screens and start asking questions as soon as we begin. If you are joining us on the live stream or by phone, you can submit a question by emailing events@mei.edu. So Tim, I'm going to hand it over to you. You can share your slides and begin sharing your findings from the report.
Very good. Thank you very much, Karen, and thank you to MEI for hosting this webinar, and thank you to Faris in advance for being the discussant of the presentation. So as Karen said, we released our annual report on Saudi Arabia last week. So the presentation is going to run through a few of the issues from that. So let me give you to start with a, okay, there we go, slight delay there. So let me give you a brief outline of what I'm going to talk about, and all of this you can find in more detail in the report. Most of the slides are just taken directly out of the report itself. So I'm going to start off with a brief discussion on the impact of COVID on growth and the policy response from the Saudi authorities. Then look at the economic outlook, mainly in the short term, but we'll say a few words about the medium term as well. And then look at three medium-term challenges briefly on fiscal, labour market, and on the greenhouse gas emissions, where I think Faris in particular has an expertise. So, you know, sort of in some sense teeing up there some broader discussion on that issue. So let me just start with a quick look at the you know, the impact of COVID on the economy, and there's probably nothing new here, but you know, what we can see is clearly in terms of non-oil economy, a big hit in terms of growth in the second quarter of 2020 as the lockdown was implemented. And also, you know, sort of beginning to see a hit on the oil sector as the OPEC Plus agreement kicked in towards the end of that quarter. So overall, total GDP clearly slumped quite significantly in the second quarter. But then as the lockdown eased, rebound started to take hold in Q3 and has continued through the first quarter. Non-oil growth seeing quite a substantial pickup, which has dragged overall GDP up. Clearly, the oil is a separate story there, where we're still seeing year-on-year weakness in the oil production given the OPEC Plus agreement. And if we look at, you know, some of the components in terms of domestic demand, really private consumption slumped significantly as people you know, lost the ability to move around and go out easily in the second quarter, but that's rebounded quite strongly. Investment also rebounded, and I'll come back a little bit on the consumption story when we talk about the outlook in a few slides. Again, probably nothing too new here, but, you know, just to emphasize the sectoral impact of COVID was clearly significant divergences across sectors. And I think important here that this slide has different scales, so don't get confused by the scales here. It takes a while to focus on this, but what it's saying is particularly transportation, hospitality, and trade saw big hits. Social services in the second quarter. Other sectors were less affected. Surprisingly, in some way, construction less affected. Finance probably not surprisingly less affected. But we've seen rebounds across all of these sectors. And now, from relatively aggregate sectoral data, all of the sectors are now have GDP levels. All the non-oil sectors have GDP levels above where they were before the COVID crisis. So we've seen the rebound, and that, of course, is now true for aggregate non-oil GDP is now above its pre-crisis level. Looking at the impact on the labour market, clearly, we have seen a differential impact between Saudis and non-Saudis. There was a small decline in the employment of Saudis in the second quarter. Here I'm showing cumulative changes since the beginning, since the end of 2018. So read the left-hand chart in that sense. So you can see a small decline in Saudi employment in the second quarter, but that quickly rebounded. Whereas on the expatriate side, we've seen actually for a more extended period than shown in this chart, declines in expat employment, and that picked up again particularly in the Q3 and Q4 last year. Again, I think there are some particular specifics in some of the labour market data and how it's recorded that may explain some of the quarterly movements here. But clearly the expatriates have been affected more than Saudis in terms of employment prospects during COVID. The other thing we've seen, and how much of this is in the period statistical and how much is actual, is I think a question of interpretation. But we've seen a continued increase in the female labour force participation rate, which has been ongoing for for several years now. We can maybe, if people have questions about this, come back to this in the discussion. My own personal sense is probably the participation rate was under-recorded in the period before COVID. Probably the increase during the COVID period may be exaggerated by changes in the statistical approach to the labour force survey, but probably in aggregate, we're looking at something that's now approximately right in terms of that participation rate. So looking at the policy support provided by the Saudi authorities, clearly quite a few programs were implemented in March and April last year in terms of tax and fee deferrals, in terms of the employment protection scheme through SANID, and through various programs the central bank has implemented together with the bank. So particularly I think the deferred payment program, but also expansion of the loan guarantee program. So if we look in a global context, the sort of support provided by the central bank is approximately the level we saw in advanced G20 countries and somewhat stronger than or larger than in the emerging markets. The fiscal response, though, has been, in aggregate in 2020 was smaller than the G20, and we'll come back to some explanation of that in the next slide. And then in terms of the interest rate reductions from SAMR, of course, with the pegged exchange rate, they've followed the Fed, and the cut has been 125 basis points, both in March 2020. So, say on this chart, clearly, most of the support has been financial rather than fiscal. But let me give you one caveat to that. And that's if we try and construct a a non-exported oil primary balance measure on a quarterly basis. And this is our preferred measure of the fiscal stance, because we're stripping out sort of the oil revenues that come from overseas, which are not really in the first order affecting the domestic economy. But what we see is an expansionary fiscal stance in 2020 Q2 as the particularly the tax and fee deferrals kicked in and a few other measures. We then see quite a tightening in Q3 as the VAT rate was raised, the COLA allowances were removed. And then we see a move to, again, a somewhat more expansionary policy in Q4 as spending began to pick up towards the end of the year. So I would say, in aggregate in 2020, clearly fiscal was, was less expansionary than in some other countries, but the fiscal support was really there at the peak of the lockdown in terms of helping companies in particular weather that period where corporate revenues dropped substantially. Another thing I think that's been going on, it's important to recognise, is for a number of years there've been efforts to increase mortgage lending, SME lending. Clearly, the government has a big housing programme that's been underway and has been making a lot of efforts in terms of SME lending. So we've actually seen pretty strong credit growth going on through the pandemic. And here, looking at the data to end 2020, we can see really that lending for real estate has really driven credit growth, but also lending to SMEs as well. And if we look on the right panel, it's just showing the ratio of bank credit to non-oil GDP, and then relative to a trend. And really for the first time, since the late 2000s, or 2008, 2007 period, we're seeing credit to non-oil GDP above its trend level, pushed by these expansionary policies. And again, I think that's sort of been contributing to the relatively good outcome in the non-oil sector we saw last year relative to many other countries. So let me then just move on to look briefly at the economic outlook. And the first thing is clearly what we've been seeing is a recovery in both business and consumer confidence from the periods. I mean, in the business side, from March, April last year, the consumer confidence in sort of in terms of the trough was probably just in the period after the VAT and the COLA changes, but both have recovered to pretty much where they were, or in case of consumer confidence, somewhat above where they were in late 2019. I think the other interesting thing is, what has happened to savings and, household savings in particular, and what is the potential pent-up consumption that is there to drive growth going forward. And we don't have a measure of household savings on a sort of quarterly or monthly basis or anything up to date, but we can get a sense of it by looking at sort of a calculation of wage income taken from the estimates in the labour force survey, and then consumption. And what we saw up until the period in late 2019 was consumption growing more strongly than wage growth. What we've seen in the period during the crisis is clearly wages continuing to grow, but consumption slumping and then beginning to pick up. So the suggestion there is clearly household savings increased and is probably still substantially higher than it was pre-crisis. So there is, I think, still pent-up consumption potential there, although some of that has clearly been eroded as consumption itself has rebounded over the last few quarters. So this is just giving a summary table of the key forecasts we have in the report. And maybe just highlight a few things. I mean, clearly, the first one is the non-oil GDP growth, where we're expecting a reasonably robust rebound this year after the contraction last year. 4.3 is an upward revision that we've made during the course of the consultation. So I think, relative to earlier in the year, we've revised this up a number of times as the high frequency data has come in. And then on the oil side, we're still expecting a modest decline in oil GDP this year. And here we're assuming that the OPEC Plus agreement, as it's been set out previously, continues. But then that by April next year, the agreement ends, and then we begin to see growth in line with what we project in terms of global oil demand from there onwards. So that's why, we see a rebound in 2022, and then the sort of growth in terms of what we're expecting for the global oil demand over the medium term, I should say. In terms of the fiscal and the current account balances, see big improvements this year. Clearly, a large part of that story is the oil price itself. But on the fiscal side, of course, we have the full year impacts of the value-added tax, the COLA removal as well, and the government's cutting back on the budget, at least, of capital spending. And then on inflation, I think inflation's an interesting story. I mean, clearly we have the base effects from the VAT through to the middle of this year. But then, we've had relatively benign inflation outcomes month on month in the early part of this year, but some signs of inflation picking up in the more recent monthly data, particularly on the food price side. So I think that's something to keep an eye on, particularly given the concerns at the global level, and particularly in the US about the recent inflation development, to see whether the inflation forecast is going to be perhaps a little bit on the optimistic side at 3.2%. One other thing I just wanted to mention in terms of the more medium-term projections, we began to produce this chart when we were starting the discussion with the authorities, which was in April, and we wanted to look at sort of how the drop in oil revenues during the COVID period compared to other periods of sharp oil price declines. The chart here is just showing the comparison to the 2014 oil price drop, where if you took our last Article IV report before the oil price decline, took the baseline there, and then the actual eventuality in 2019, the oil revenues were 40% below what we'd expected at the time of the 2014 report. Then we looked at where the oil revenues were relative to the January 2020 World Economic Outlook projections, which is clearly the last one the IMF did before COVID. And when we started doing this, the drop was about 10% in 2025. So we're expecting some significant sustained decline in oil revenues. But given what's happened in the oil market, that decline in the report was down to, when we finalized projections in the report, was down to 3.9%. And actually, probably if we redid this now on current futures prices, it would be even less than that. So it's, I think, an interesting, perspective going forward that, I think we were very concerned in terms of the forecasts about the, about the long-term impact on the oil revenues, what that would mean for the fiscal, the current account, and then feeding back into growth. But that now, at least taking futures prices as they currently stand, seems to be less of an issue. Of course, this could change again depending where OPEC Plus and other factors come out. The other thing, just in terms of projections on the fiscal side, this is, I think, probably the report where our fiscal projections are closest to the authorities. We tended to have more substantial differences in the past. And this time, clearly the authorities are expecting, or, in the budget, have the budget balancing by 2023. We're not quite that optimistic, although the authorities do include privatization receipts that they assume will come in revenues, which we wouldn't include in revenues. So I think if you took those out, we would actually be pretty close on the deficit side. We expect somewhat higher expenditures. I think if anybody's looked at the budget, there are quite substantial nominal expenditure declines expected in the budget, in particularly 22 and 23, which we're not fully sure how they will be realised. But on the other side, we're generally more optimistic on revenues. This year it's because we expect a stronger rebound in the VAT than the government does. And then probably beyond that, it's more of an oil price story, although of course the authorities don't disclose the oil price assumptions. But I mean, a fiscal position generally that's sort of much more in line between us and the authorities this year than in the past. Then the other thing I just wanted to show, of course, one of the things that we're seeing happening, and I will come back to this a little bit in the fiscal reform discussion, but clearly we're seeing expenditure, particularly capital spending, being moved effectively off budget, and the PIF picking up some of this. So what we've done is try and include in a measure of expenditure and the non-exported oil primary balance, also announced spending by the PIF. Of course, we're assuming here that the PIF implements 100% of what it announces, which may not be the case. But this just gives you a sense of the expenditure path and the non-exported oil primary balance if we include the PIF spending. And I think the story is, less of a consolidation in 2021 if you do that, and clearly higher expenditure and larger non-oil primary deficit as well, but the paths would be pretty much the same once we're beyond 2021. So then let me just turn briefly to three medium-term challenges. And here, this is, I think, a lot of it is to set up, hopefully, what can be an interesting discussion on these issues. Let me pick two on the fiscal side. I mean, I think the first thing is, and I think, this is becoming very relevant again, is the pro-cyclicality of fiscal policy that we've seen in the past. So when oil revenues go up in the past, generally government spending growth also picks up, and that's shown in the panel on the left. And that pro-cyclical fiscal policy, I don't think is useful. It creates volatility in the economy. Of course, maybe it's nice in the upswing when you can spend more as oil revenues increase, but then you have to cut back on the spending in the downturn, which is pretty disruptive to the private sector who are reliant on this government spending. So, sort of controlling better that pro-cyclicality is important. I think there's going to, clearly an ongoing test is upcoming in terms of the strong growth we're seeing in, or strong increase in oil prices we're seeing at the moment. So that'll be a good test for the authorities. But I think it's fair to say the fiscal framework has been strengthened significantly in terms of expenditure management, budget planning. So hopefully that will result in less pro-cyclicality going forward. On the other side, just showing the government wage bill, it's high in Saudi Arabia. Of course, the removal of the cola last year helped, but it still remains high, and that's going to be a challenge in terms of fiscal consolidation. I think it's certainly not realistic and probably not even desirable to be thinking about rapid changes here. But I think for the government to be as people retire or leave the civil service, whether they need to be replaced, certainly if it's non-essential, I would say not replacing them. reviewing allowances that government employees receive in terms of making sure they're needed. And over time, while this is probably not going to result in any nominal decline in terms of real spending as a percent of GDP, it should begin to bring the wage bill down. I said, maybe a brief word in terms of, sort of the PIF and the broader fiscal. I mean, so, one thing that, is increasingly happening, clearly a lot of the action on the broad fiscal is taking place outside of the central government now. The PIF is clearly taking a much bigger role in the economy. You also have the government, sort of redeveloping, in a sense, of specialised credit institutions under the umbrella of the NDF. You have Aramco clearly now as a public company, but also I think again, sort of taking a significant role in economic development. So it's important both, I think, from a flow perspective of measuring the impact of fiscal on the economy in any one year, but also in a stock position to take a broad view of the public sector. In the report, and I'm just putting this out here more as a teaser and hoping I could interest you in the annex we wrote on the public sector balance sheet in the report. But this is just numbers of us trying to put together from public sources a broader view of the government balance sheet, including the PIF, including Aramco, including the NDF. And the outcome, of course, is that the fiscal position measured by a net asset position is very strong, around 500% of GDP. So it's it's a stronger position than you would find at the central government level. But of course, also, if a lot of spending is happening outside of the central government level, that is going to have a bigger impact over time, depending on the investments, depending on the build-up of liabilities. And really keeping a tab on this broader measure, I think, is going to be really important for the government as they move forward. And it's welcoming that they are thinking and developing a sovereign asset liability management framework themselves to begin to look at the broader public sector here. Then maybe just one slide on the labour market. And again, we've seen a lot of reforms in the labour market over time. We've seen a lot of sort of efforts and talk about developing new sectors of the economy. I think one of the primary challenges here, of course, is trying to get wages and productivity more in line in Saudi Arabia. So what we've done in this chart is look at the wage of Saudi nationals and made an estimate of their productivity levels, which we've based on the Human Capital Index published by the World Bank, and then a cross-country regression of productivity and human capital plus some control variables, because we don't clearly for Saudi have a measure of productivity as it applies just to Saudi nationals. And the estimates come out that, I think this is probably not a surprise to a lot of people, that, sort of wages are higher than is justified by the productivity level. And this is going to be, I think, one of the challenges for the labour market reforms. How do you bring wages and productivity over time more in line with, more in line to enable competitive businesses and private sector to develop? And probably a lot of it's going to have to be on the productivity side, given wages are unlikely, at least in nominal terms, to adjust. And there, things could be actually, bringing more women into the labour force. And they're probably, sort of productive workers who can be brought in. It will clearly be strengthening education and training. It'll be, things like, probably flexibility in the labour market, allowing greater movement between sectors and encouraging that. But I think this is going to be one of the challenges going forward in the next stage of the vision reforms. If you want to develop new competitive sectors of the economy, getting a competitive workforce for those will be very important. And then the last slide, just on the greenhouse gas emissions. So we had a short box in the report looking at the green initiatives and the efforts on the carbon emission side. And I think, one thing I think we point out, and it's important to point out, is there have been quite a lot of reforms on the energy price side in recent years. And I think, certainly from my side, I'm actually surprised on the gasoline side how far and how quickly things have gone, even acknowledging the recent decision to cap the gasoline prices. We've seen quite a lot of efforts in terms of energy efficiency, measured in terms of air conditioning and car emission standards and so on. And we have seen progress in some sectors, transport, building, a little bit in the power sector. But it's pretty hard overall to get a picture on sort of other sectors, because some of the data is pretty out of date. And then clearly as well, sort of in terms of per capita emissions, Saudi is quite high, so it has a long way to go to move this down. So it's going to be interesting when the government comes out with details of the Saudi Green Initiative, which I understand will be by the end of the year, what policies are put in place to further address this issue. And then also the information availability, I think, is an area that needs addressing here. So it's easier to monitor what is going on as well. So let me stop there and hand it back to you, Karen. Thank you very much.
Thank you, Tim. You've given us so much material to try and digest, and luckily we have Faris Al-Suleiman here to give us a little bit of his own insights of what we should be looking at. I mean, big questions for me are, these are challenges that we've all known about in terms of labor markets, in terms of the real overriding role now of the PIF in terms of the domestic demand and domestic economy. But Faris, let me hand it to you. What struck you as interesting or new in this report and these findings?
Yeah, thanks, Karen. Can you hear me all right? Great. Thanks for the introduction. I'm happy to be here and happy to join Karen and Tim. I was kind of thinking the other day that these consultations have been a part of our professional lives for 10 or 12 years. I've been reading them for a long time, so it's nice to get the chance to comment and discuss them. There isn't, I was trying to think, there isn't much I can easily add to the macro picture that Tim just gave us. I thought it might be a little bit more useful to pick at a couple of points that maybe are not addressed as much in as much detail in the report. The report's pretty comprehensive, but that in my view kind of play a bit of an important role in the macro story that Tim kind of sketched out for us. And the term that I think Tim and his team were using a lot in the report was this idea of policy momentum, and they discussed and praised it a lot, and I think it is undeniably strong as they describe even before the pandemic. But there are interesting discussions about the direction that we're headed in and the implications of that. So I'll try and touch on one or two of these points. The first point is that there's obviously a lot of praise to be given for the fiscal consolidation that's taken place, and Tim talked about that quite a lot. The great strides have been made, and obviously the increase in non-oil revenue demonstrates this, but still some of the toughest areas kind of still remain ahead of us. Tim alluded to this in the report, but particularly the wage bill and more substantial, serious energy reform are still things that lie ahead of us. The use of VAT, obviously rising from 5 to 15% in the middle of the pandemic, was the first port of call, and it's understandable. I guess it is an easy policy lever to kind of engage in that situation. But still, as Tim also suggests in the report, the impact on low-income households is quite substantial. These 15% VAT can be quite regressive. Obviously, there are other policy tools that are being put in place. But that's something to think about. And energy subsidy reform, on the other hand, could potentially have more progressive, more targeted impact, and particularly in electricity prices, which are priced in slabs, right? There we have a host of possible positive spillover effects in renewable energy deployment and energy rationalization, and subsequently some of these GHG and climate goals. So the choice of VAT versus energy subsidy reform is quite an interesting one. Probably we're going to get there on all fronts eventually, but one to think about. Then there are two kind of underappreciated points that I thought I'd mention. Tim and his team mentioned both of them, but maybe to stress them a little bit, that the Citizens Account Program, CAP, and the new kind of social security framework that Tim mentioned and discussed in the report really could form the foundations of a more equitable post-rentier distributive system. This is kind of a big deal. It's quite groundbreaking and under-discussed, I think, if a minimum guaranteed income does come into place and the interaction between these programs is well managed. I think this would be a big development for the political economy of the Gulf, and this has recently become a bit of a hot topic. I think recently Tim was on a panel with my supervisor Stefan Hertog discussing the potential for similar proposals in Kuwait and other Gulf states. But this is a big deal. If Saudi is able to crack it in the next couple of years, there's opportunity for policy leadership, I think. The second point, and I think one that's touched on also briefly in the report, but is actually really important, maybe out of all the vision realization programs, is one of the ones that strikes me as being quite important, is the industrial development front. And I remembered, funnily enough, a couple of years ago, the IMF, Sharif and Hassanov put out this report about industrial policy in the Gulf, and a couple of us found that quite strange coming from the IMF, but it seems like it is an area of importance, and it would be interesting to revisit some of those propositions and those themes in light of new plans that have been announced. But I think it is arguably one of the most important ones to look at. And in the strategy, I think we have the seeds of what might develop into kind of a serious export-oriented, technology-driven industrial framework. And getting it right, I think, is important to long-term reform. And there's been some progress, but maybe something we can focus on a bit more in discussion if there's interest. And especially if we can move past the import substitution and the focus on extractives and coordinate better within a GCC framework, ideally in a more integrated kind of single market setting. The last point I'll get to is also one touched on briefly by Tim and his team, but is the focus of a lot of my work and research, and is related to kind of the role of state-owned firms and the PIF in shaping this new economy. And clearly what we've seen over the last 5 years in Saudi and the UAE as well, and some of the other Gulf states, is the deployment of a kind of state-driven, state capitalist model, and one that more closely resembles developmental states or other models from East Asia, not more liberal market economies that we might compare to in the West. And it in the end, it may be what suits the post-oil rentier economy best, in a situation where the state, if you will, is holding the cards, is the main holder of capital and assets when the game starts. So the 2019 and 2021 reports, consultations, both advise moving towards a kind of transparent exit model for these newly launched SOEs, state-owned firms. But we may have to live with them for a long time. I suspect we will. So it would make sense to kind of focus and build on working through frameworks to manage these state-owned assets in the meantime, and learn from states, mostly in Asia, that have done this well, integrating strong oversight, SOE competition, and market dynamics into this equation. And again, ideally, obviously, in a coordinated manner with our neighbors in the GCC and as part of a larger integrated market with all the benefits that come with that. So I'll end there, and I'm eager to hear what Tim and Karen and others have to say about that.
Thank you, Faris. That was great. I don't know, Tim, if you want to respond directly to Faris, and then we can go to some Q&A.
Yeah, absolutely. I mean, no, I think Faris raises good questions, and I mean, maybe let me just comment on a couple of things. So I think the energy price reform is clearly one, and then maybe a little bit in terms of the broader PIF industrial policy, which I think is a tough one to crack and think through. But on the energy price reforms, I mean, I think the Faris is right, and as we say in the report, completing this agenda is going to be important, both from the climate perspective, but also, I mean, our fiscal projections assume energy price reforms continue and revenue comes to the budget from that. So it's both a narrow fiscal and a broader, I think, economic development issue. I completely agree in terms of using the citizens' account in terms of both on the energy price side and on the VAT side in terms of sort of compensating on low-income households. I think electricity further, water is another area clearly where there's going to be reforms. I think maybe what's the tougher area, the households, I think we have a reasonably good idea how to compensate. It doesn't mean it's politically easy. The corporate sector, I suspect, is more difficult because there are clearly a lot of energy dependent companies, a lot of the sectors built up in Saudi around that. And I think it's much harder to work out how you effectively compensate the corporate sector, or how you help them adjust, and what are the impacts of that. So I think there are important challenges there that will need to be thought about. The PIF, I think it's, to me, it's sort of, a little bit of a double-edged sword. In the sense, I completely buy into the argument of there are sectors that you may want to develop that are large. They need big capital. There's risk involved, and it may well need the public sector to get involved in doing those. If you're doing that, of course, there's often no market test of these sectors, so there is a risk that you commit a lot of capital with an uncertain outcome, and that, I think, is where strong governance and transparency at least can play some role in this. On the other hand, if the PIF or the public sector is developing absolutely everything, then the private sector basically remains a government contractor. It's just contracting to the PIF rather than the central government. So you're still having a private sector that is very reliant on the public sector rather than the private sector itself developing new areas. Then, of course, there are broader risks of crowding out. And I think how you get that balance is, I certainly don't have the answer. I'm not sure anybody does. But I think there needs to be a balance that the PIF, yes, is going to be involved in developing some areas. But you also need to create enough room for the private sector. And there really, the regulatory framework is, I think, critical. The availability of capital is critical, right? Yes, tax incentives are probably going to be used, certainly at least in initial development of some of these sectors. So, those are thoughts rather than answers, I think. But I think there's a lot of thinking around this area that we all need to do. And I agree. I think it would be, the paper that Fouad and Rader did in 2014 was sort of ahead of many of these new vision programs that had come out. And I think revisiting some of those issues they raised and where we are on them would be a useful exercise. Let me stop there. Thank you.
That's great. I'm really struck by this theme of getting beyond taming the pro-cyclicality, as you say, which I think is a great phrase. But also at the same time, the nature of the PIF and its outsized role in the economy, the commitment of $40 billion a year of domestic spending. But as you say, there's some sectors where the state is more welcome. For example, the Saudi electricity company, the SEC, has a target of I think 50% renewable power production in the next 10 years, compared to about 1 or 2% right now. So where does that investment, who pays for these new power plants that are solar? Where do they come from? But it's a good policy mechanism, because if you look at where most of the emissions are coming from, it's not Aramco or SABIC, it's the Saudi electricity company, and mostly residential and corporate, consumption there. So, I think, Faris, you're exactly onto, the right point, sort of tackling those energy subsidies and making that policy aligned with climate goals. but the money still has to come from somewhere. And, Ferris, because I know you know the solar sector really well, what do you see as, the PIF's role in buying Aqua Power or buying up other solar producers? Who is best equipped to help manage that target and that transition?
Yeah, it is kind of an interesting one. I don't know if I'm well placed to judge who's best placed to manage the transition, but we can look briefly at kind of the renewable energy landscape as an interesting kind of test case of who's paying for what, right? So currently the Saudi public procurement framework, which is related to renewables, is a kind of a subdivision of the Ministry of Energy and is in the third round of tenders for these large mega projects, wind and solar projects all over Saudi. They built one large solar project and one large wind project, and a couple more are coming down the pipeline. And these are all mostly being won by consortiums that are led by state-owned companies. Some of them by Aqua, some of them by Masdar from the UAE, a couple by EDF, another French-owned state-owned company. And as far as we know, the plan that we've been told last year is that these kind of projects, which are independent power producing projects, will account for 30%. So they'll account for 30% of this renewables plan. The other 70% is going to be developed directly by the PIF, initially with SoftBank, but now potentially on its own. And so this is PIF capital or related debt that's going to be deployed in building it. So this is kind of a model. I don't know. Maybe it's not so useful to discuss. It's kind of more useful to discuss. Okay, we've gone down this road. How do we best manage this the set of choices that have been made? And I think it's there's a balance here that they're trying to strike in the renewable energy landscape between these IPP projects that have some FDI coming in and a mixture of private sector and state-owned participation, and then the PIF, which also wants to participate in this growth story, right? It also wants to take advantage and build some of these projects and sell that power to the SEC. But it's kind of an area that's understudied, and the renewable energy landscape is one that's kind of being drawn up from scratch, and is indicative a little bit maybe of the direction we're going to head in some of these other industries.
Thank you. And I hope your work at MEI is going to help us understand this more. We've got some great questions in the Q&A if you guys want to sort of engage. A couple of them about inequality in Saudi Arabia and how social mechanisms like the citizens account to support lower income citizens and vulnerable people. How is that working? Any thoughts on the evolution of poverty and inequality is one question from Raza. What's the status of the Citizens Account program or its projected timeline from Victor? And then we've got some questions more, one very specific for Tim, perhaps. Are petrochemicals contribution to GDP, is that accounted for as oil or non-oil GDP? So how do we explain this non-oil GDP growth story, which is very interesting? I think it's a domestic consumption story, a sort of captive shopper. And then Tom asked, perhaps for many years, government statistics on economic and labor conditions were unreliable. Is that no longer true? I would just say we're getting much better data, particularly on labor markets now from the Saudi government. So that's my opinion. But you can take those in any order you like. Should we start just with the sort of factual questions on petrochem, and then let's talk about inequality and sort of social mechanisms to support low-income people?
Very good. So let me go first. So petrochems is non-oil. So the oil is basically the crude plus the refining, basically. I mean, there is a little other thing in there. Petrochemicals is non-oil. On the economic statistics and labor statistics, yes, I agree. I mean, I think the statistics have improved significantly in recent years, and are continuing to improve. I think the labor is an interesting area where I think there's still confusion in interpretation. I mean, maybe that's not quite the right word, but let me explain. So the unemployment rate, the participation rate come from the quarterly labour force survey. The employment statistics that are published by GA Stat come from the administrative data of GOSI and the Ministry of Human Resources. So they are not consistent, right? So you may get an employment story that doesn't look consistent with the unemployment rate and participation rate. And there is no published employment series from the labour force statistics at this stage. The other thing that's happened clearly during the pandemic is that the labour force survey used to be conducted in person. It was conducted by phone during the pandemic. And I think that that's had, as we understand it, a number of implications, right? One is it used to generally, and maybe, solely be conducted by males in person who would often speak to the male head of household. Now on the phone, it's a combination of both women and men doing the surveys, and it seems more likely that they also reach women in the household. So that is one potential explanation of why the female participation rate has increased, that it was basically under-recorded under the old system and is now being recorded more effectively. Of course, we'll probably need to see this data for another period to really be able to make judgments on it. But in sum, yes, I think the data is much better. But there are areas that still need improvement in terms of helping us fully understand the economic picture. Data on poverty and inequality is very, very limited, right? I mean, yes, there's a Gini coefficient published with the household income and expenditure survey, but my understanding it's an expenditure Gini, not an income Gini. But beyond that, I don't know of any other data on this area that's in the public domain. More broadly on the citizens account, and I guess there were a number of questions, and if I don't answer them, please come back on me on this. But the citizens account program is clearly one part of the social safety net, and at one level you could argue it's broader than a social safety net program because it focuses more on than just the bottom 20 or 25%. And then there are clearly a whole load of other programs that go on as well. Those sort of, I guess, more long-standing traditional social safety net programs are what are being reviewed under the social security law and will, I think, be replaced by the guaranteed minimum income. On the citizens account program, I think when it was introduced, it was recognized that the targeting would be refined over time because there, it was done, not all the information was there to do it effectively, but it was important to have a program in place. And I think that has been refined over time in terms of, particularly I think, the ability to double dip where somebody might be counted in a household and then separately apply as an individual has been addressed. And that's one of the issues you saw, why you saw a drop in the spending on the citizens account in early 2020. But I think it's an interesting question as you go forward and you do the reforms under the new social security law. Do you then move ahead and try and broaden that to sort of have some universal income scheme which would effectively incorporate the citizens account into that one payment to households? I suspect over time that may be the direction to go, but it will probably also be quite difficult to do and I suspect take a while. So let me stop there. If I've missed anything in terms of the questions, Aaron, please come back. I'll try and address them.
No, I think that's pretty comprehensive. Thank you, and that's good information about the labor statistics to help shed some light, perhaps on the really positive news we've been seeing in terms of women and women's labor participation and employment. And one statistic I saw from a recent Jadwa report was that so many more women are working now in the private sector. And also surpassing male labor force participation in a number of sectors, including, or most everything except construction and public administration and finance. The finance one, I think women can increase their numbers there, but maybe not in the other two sectors. But we also know that women are generally paid less when they work in the private sector. So kind of, how do you, and there are some policy shift to sort of guarantee wages for women. So we'll see how that pans out. Faris, you're welcome to chime in. We have one other question, sort of a factual one. How is the PIF's sort of contribution in domestic spending? Is that part of what we see as the budget or not? I'd say it's outside, but Tim, you want to comment there?
Correct. It's outside of the budget. Yeah. So, I mean, our argument would be you need to construct a broader measure of, fiscal policy, the public sector that includes the PIF, given it's doing a lot of investment and spending domestically.
Yeah, that's right. Faris, any other comments on your side to these questions?
No, maybe just briefly on the size and scale of the Citizens Account program, which I think Tim probably knows much more about, but seemed to be a point of curiosity with someone in the audience. It's that initially the program was meant to be targeting something in the range of 12 million people through a smaller number of households, and has since then shrunk by a couple of million people to somewhere in the 10 million range. I haven't seen the most recent report, and then they're given between 200 and I think it is 900 or maybe even more than 1,000 reals as a cap in spending, and this will have to kind of adjust, and as Tim suggests, with increases in VAT and the removal of the cost of living allowance and other things, that this is something that they could play with, a policy lever that they could play with. But yeah, it's definitely as the infrastructure that was set up here is unique in the Gulf, at least at the moment, or not unique, but important. I think there are similar analogies in maybe, correct me if I'm wrong, Tim, in Iran, and then maybe in the UAE as well. But if we can build on this will be a pretty good foundation that will open the door for a lot of other kind of policy reforms, like the energy subsidy stuff.
And just as a sort of last question, I think a lot of people are asking, how do we explain this positive non-oil growth story in Saudi Arabia in the last year, particularly, a horrible recession from the pandemic. And, I would say a lot is the VAT revenue to the state. A lot is that we had a decline in economic activity. So when you see the up curve, it's from certainly not from the oil sector. So that's part of the story. And then also, I think it's, people were not traveling, they were at home. We saw, as you saw in your chart, consumption took a steady dip, but then increased. And this expansion of credit has been really incredible, right? Sort of the timing of that, and that is part of the Vision 2030 initiative, I think worked quite well. But Tim, any other explanation you would add to that?
No, I think you've got most of them. I mean, again, it's hard to get sort of hard facts on what the PIF is doing, but I mean, the sense is as well that the PIF program sort of clearly there was a general pause in the economy, but have probably also picked up pace from sort of later last year and into this year. So I think I would add that in as well. But I think a lot of it is, I mean, if you think, the non-oil economy was growing, if I remember, it was like 3.3% in 2019, minus 2.3% last year, 4.3 on our forecast, this year. So even with that, you're still not really back to the growth trend that you'd seen immediately before the crisis. Of course, it was a bit weaker in the years before 2019. And one of the reasons why we have a growth slowdown in 2022, I mean, still quite robust non-oil growth, but slower than in 2021, is the expectation that part of 2021 is a rebound effect from 2020 rather than a sustainable pickup in growth.
All right, well, we are at the top of our hour. We didn't get to a couple of the ending questions, but we will continue addressing all of these issues within our program on economics on energy at the Middle East Institute. I'm especially grateful to Tim Callan for letting us host you and sharing this report. And I'm grateful to Faris for sharing his insightful comments and expertise in understanding the Saudi economy so well. So thank you both. And we hope to have you back with us for another event very soon. Enjoy your summer breaks.
Very good.
And thank you, everyone.
Karen. Okay, bye-bye.
Bye-bye.